What's going on, YouTube? So in this video, I'm going to go over how to find your edge in trading. You see, a strategy is one of the most important things to have, and there's a common mistake that a lot of traders make while trying to find this edge that I'm going to go over in this PowerPoint presentation. By the end of this video, one, you're going to know the 3 stages of a trader. You're going to know the roadmap to take in order to see trading success in your edge. And also, I'm going to give you step-by-step solutions of how to find your edge and also build experience. And also, little bonus tip, learn how to think in probabilities. Without further needed to be said, let's go ahead and jump into this video. All right, so let's go ahead and get started. So the name of this PowerPoint and where we're gonna go, what we're gonna be mainly talking about today is just basically mechanical edge engineering. This is just fancy for building your strategy. The main things I want to look at, or the sections I kind of want to look at, is the first I want to uncover the stages of traders. You see, every trader goes through a certain stage, and I want to uncover the 3 stages so we can understand where most of the problems stem from when finding a strategy that best suits you. Second, I just want to look at the problems from taking strategies from others, and this is borrowing strategies from others. I want to uncover some of the main problems that it may cause us and how we can deal with those problems as well. And then third, I'm going to personally go over how to build your edge. So when I get to step 3, I'm going to kind of go off topic a little bit. I'm going to actually show you how I do it. And then 4, we're going to go over a quick summary. So the first things first, let's go over the 3 stages of traders, or the 3 stages every trader should go through. So I've learned this concept from Mark Douglas, and he talked about it a little bit in, I believe it was a DVD seminar that was recorded on DVD, and this was one of the most impactful things that I got from it, and I just want to share with you guys as well too. So there's 3 stages of, I guess you could call, the trader journey. There's mechanical, subjective, and intuitive. So mechanical, right? Let's go over mechanical first. Mechanical traders are traders who follow a rigid rule plan. They have rigid rules that they follow, and they follow that only. Don't care what the market condition is, none of that. I don't care if it's trending upwards, trending downwards, whatever their rules are, they follow it. They don't allow rational thinking to interfere with their trading. They have a checklist, they go by the checklist, and they just do that and do that only, and they just focus on following those rules. And I apologize for the train. It's making quite a bit of noise. But that's what a mechanical trader is, right? So say, for example, a mechanical, I'll give an example here. My stage of being a mechanical trader was just trading the Fibonacci. I would mark it up at a higher high, higher low, wait for it to come down to the 50% level, and then enter. That was my mechanical strategy, my mechanical edge, because all I was doing was following those rules no matter what the circumstance was, and I wasn't allowing myself to think of what to do next, or based opinions, or make decisions based off opinions or experience that I have gathered from the market. And mechanical is the first stage. This is where you gather all that data, and you sit there, you gather data, and you kind of build that experience from just building a lot of trades, or building a sample size of trades. The next stage is subjective. So subjective is most of the traders you see. These are traders who kind of trade through their experience, and they make decisions based off of their experience in trading. For an example, right? You'll see most traders, they'll have this certain rule in their strategy that isn't necessarily based off a rule which everyone may have, but it is based off of the experience they've gathered through the market. For example, a rule that I've gathered is every time price comes down to my 0.79 level, I instantly cut my losses short. This is my form of subjective thinking, simply because I've noticed through my opinions based off of market situations, based off of the countless reps I've got from watching the market and watching my edge first play out as a mechanical rule or a mechanical edge, I've noticed that every time it came down to the 79 level, it was most likely to hit not take profit, SL, about 90% of the times. So with that in mind, now I'm using my thought process, my thinking, my opinions, my ideas that I've gathered through experience in the market to kind of trade or kind of allow myself to do rational thinking in the market. And then third is the intuitive stage. So this stage, you don't necessarily see a lot of traders in this stage. Majority of traders are going to be in the subjective stage, where they just basically try to use rational thinking in order to trade. But the intuitive are kind of traders who are, if you so-called could think of it, they trade in a flow state. They trade in a zone. If you compare it to athletes, if we had to compare these to athletes, we would compare this type of traders or these type of traders to traders who, or athletes who put up a dominant performance by playing in the zone and just having an absolute flow state. They trade based off instinct. And what this means is most decisions that they make cannot be understood by reason. They usually just do it because of just gut feeling, intuition. And that's what the intuitive stage is. And these traders are an absolute flow with the market. They've gotten over all their psychological problems that stops them from getting into the flow state and start trading in the now moment with the market. These are the 3 stages of every trader. The problem is most beginners start to skip levels, right? So most traders in general, right? And this is something that I've noticed, go from beginner to subjective thinking or a subjective trader, right? And if you look at it in the video game, right, you don't go from level 1 to level 100 without going from level 1 to level 2 to level 3, level 4. But we make this mistake all the time in trading. And I'm going to go over some common examples. The first one is picking up strategies from others. I have unpopular opinion here. You should build your own strategy. Or if you're going to use someone else's strategy, you should definitely still go through the mechanical phase of trading. Here's what I mean by that. When you pick up a strategy from someone else, right? Let's say, for example, I went on YouTube and I picked up, I don't know, a YouTuber strategy on supply and demand. You'll notice no YouTuber has the same strategy. Every strategy has their own little twist. And it's because if you look at it, strategies are really personal trading styles. It's just personal edges that's different from everyone else. And you'll have traders who trade similar strategies, or like, say, for example, they trade the same concepts, but it's just little things that's different, and they'll handle certain situations different from the other. The problem with picking up strategies from someone else is it just doesn't allow you to build experience with the trades. It doesn't allow you to build experience with the edge. Now here's the thing. You're trading a strategy that you have literally no experience on. You can gain experience by back testing it hundreds of times to see how it plays out in a different situation, and then that's how you handle borrowing a strategy from someone else and kind of turning it into your own, right? But you have to go through trading that experience. You have to get those reps in while trading. The problem is most traders pick up a strategy from someone else and immediately try it out in live, and if it doesn't work out in the first 5 to 10 trades, they just give it up and move on to the next. And it's because strategies like that don't work, because when you're based in certain situations, like every strategy is based off another person's experience on the market, right? Say for example, how many support and resistance do you see that is different from everyone else's? Like people may have one support somewhere else, they may have another support somewhere else. Everybody's support and resistance strategy is different. They have the common thing in line, which is support and resistance, but they have their own different confluences and entry models and all this, right? It's because they've built experience through that edge, right? They took support and resistance through a mechanical phase, and through that mechanical phase, they were able to pick up certain patterns that the market continuously repeats, and they were able to build their own subjective thinking through it. But the strategy that they're giving you isn't the mechanical version of it, where to start. They're giving you the finished product with their experience, which is bad because you can't physically call them when you're dealing with a certain situation and you don't know how this edge plays out in this certain situation because you haven't back tested it enough. The problem that most traders do is they skip the mechanical process, and they do not trade that exact same strategy with a plethora amount of data, or they don't gather a plethora amount of data on that strategy as well too. So I know you heard me ramble a little bit, but I just kind of want to recap that whole section into one short sentence so we can get the key points out of this PowerPoint. The point that I'm trying to make here is that picking up strategies from YouTube may not be the best bet for finding your edge, because I view a strategy as a personal trading style, which is based off of another person's experience. And most of these strategies on YouTube are. So if you're going to take a strategy from YouTube, right? Or if you're going to take a strategy, or you're going to borrow a strategy from somewhere else via course, YouTube, whatever, right? Your uncle gives you the strategy, whatever. It is key that you still go through the mechanical process of creating or taking that set variable, taking the set rules that you need to enter the trade, having a checklist for it, and going through that process of gathering the data on that trade so you can build your own experience with a borrowed strategy. And if you really look at it in hindsight, every strategy is borrowed, but people make it their own through back testing, putting in the reps with that strategy, and making their own subjective reasoning. So now, like I said, the solution, similar back to what I just summarized up. The goal is just to go from level 1 to level 2. The goal is to go back to the mechanical stage. Now, here's the thing. If you're struggling with finding a strategy that best suits you, right? If you're struggling with finding a strategy that best suits you, if you're struggling to find a strategy that works, if you're thinking about changing your strategy, I want to give you this piece of advice. I want you to break down a strategy into the most simplest way possible, where you can do it over and over and over again. Create a set of static rules, and I mean static. They don't change based off of any market condition. They're always the same. Create a set of static rules with whatever strategy you're doing, right? Gather up all the confluences that you use to enter the trade, and then create a set of static confluences. For example, if you trade ICT, right, and let's say you trade a 2022 model, say, okay, cool, write down 2022 model, and then write down the rules that you need to enter the trade. Okay, cool. First, I need a sweep of a 15-minute low, or not even that. First, I need a sweep of liquidity. Then I need a market structure shift. And then I need a retracement to a fair value gap. And just trade that. Don't worry about daily bias. Don't worry about any of these other things, right? Just trade that. Just have those 3 rules. Every time it happens, you trade it. You don't worry about the outcome. The goal is to take the time to build the experience to get to a subjective level of trading, or a subjective level of trading. So going back to that example, you break down a strategy that it's so simple for you to understand that you can repeat hundreds of times because you're going to have to, right? And then you keep everything static. So go get yourself a back testing replay tool, right? Go get yourself a back testing replay tool. And then you keep everything static, right? And then grab yourself a journal, and you keep everything static from the risk to trade management and all that, right? But you just want to go from trying to use your thinking on the market to just following a rigid set of rules. Now the next slide is just going to be me going over how I found, or how I mechanically engineered my edge. And I'm going to go over the process to basically mechanical trading, and how to kind of go through this cycle over and over until you find what works. So, how to build an edge. Like I said simply a little bit ago, right? The first thing you want to do is you want to grab yourself a backtesting replay bar tool. I use FX Replay. It's very easy. It's what I recommend. It's a little bit pricey, but it's well worth it. You want to grab yourself a back testing replay tool, and you want to grab yourself a trading journal. Now listen, what I'm about to say next is for the people who are still struggling to find their strategy. If you found your strategy already, kudos, good to you. You can still improve it and you can still use this process. But if you're struggling to find a strategy that works for you, if you're hopping from strategy to the point where you're getting frustrated out of disappointment and you want to quit trading, you need to take what I'm going to say next very, very serious. Grab yourself a historical simulation replay tool, whatever you want to call it. I use FX Replay. And grab yourself a trading journal. You can create one through Notion. Me personally, I would say invest in a trading journal because it's gonna make you want to take this a little bit more serious. A good trading journal I know is Edgewonk. It's probably $150 on a year, and it's gonna be so worth it that in 6 months you're gonna be a totally different trader. But like I said, the first step of the process is to create a set of rigid rules and variables to follow. And if I can, I am going to show you how to do it. So let's go to Nuco, right? Let's go to a new node. Okay, so I'm gonna go to a new node, right? So that's how you're gonna do it. That's how you create the rigid rules, right? Say my edge, whatever. All right, my edge. First thing you want to do, cool. Remember this: one pair, one time frame, and I guess you could say one model, right? One model / strategy. You do not want to focus on anything more than just one pair, one time frame, one strategy. Do not worry about anything else but this. And you're going to grow and you're going to get better. You're going to be able to add more pairs on, but start with one everything for now. So in my example, right? How I started off was, okay, cool. My one strategy is going to be the fib, right? My one pair is going to be AUD USD, and my one time frame is going to be the 15-minute. So the first 3 questions you need to find out. You need to find out what's the pair you're going to trade, what time frame you're going to trade it on, and what model are you going to trade. If you're an ICT smart money concept kind of guy, if you believe that smart money is your trading style, then you pick one smart money concept. Now, I'm not the brightest, but I know that there's the 2022 model, there's the order block, there's the OTE, right? You pick just one. So if you want to pick, I'm only going to trade order blocks, only trade order blocks. If you want to pick, I'm only going to trade fair value gaps, only trade fair value gaps. If I'm only going to pick the OTE, optimal trade entry, only trade the optimal trade entry setups, right? You pick one model. And with this model, you pick one time frame. The reason why you pick one time frame is because you eliminate top-down analysis or any type of analysis. If you are analyzing, trying to predict what the market is doing next, you are breaking the process of mechanical trading. Because mechanical trading isn't for thinking. It's just setting up rules and executing on those rules. Right? It isn't for thinking. You're not supposed to analyze top down and think. And no, it's not for any of that. It is just simply for collecting data on an edge. And I'm going to go over the benefits in a second. Right? So, for example, that's what my edge was, right? It was the fib, AUD USD was my one pair, and the 15-minute. Now, when it comes to risk management, it's pretty simple. Risk is static. I think I misspelled that. Whatever. Risk is static. So you're not using dynamic risk, which means you're not risking you're not risking a different amount for each setup. No, you're not doing that. You're risking the same for every setup. 1%. 1% is too much for you. 0.5. And also, please do this in a back testing replay tool. Do not do this in your live. I'm going to say that again. Do not do this in your live account. Do not do this with live money. Do not do this with a prop firm. Do this. Take the time. Spend that $35 to go get yourself a back testing replay tool, because it's going to change your trading forever. Just do it. And then spend that $150 to get a journal. You can knock this out within this week right now. So the risk is static. Now, a lot of traders have trade management. I would like to move my SL to break even at once I'm this amount of percentage profit. You're not doing none of that. You're not cutting your losses short. You're not moving SL and profit. You're not taking partials. You're not doing any trade management at all. What you're doing is you're setting a TP, setting an SL. Here's another thing too. RR is 1 to 1. It's where you start. But I like, my normal RR is a 1 to 3. Abandon all of that. Just try this. Just try this. I promise you're gonna find an edge doing this. But it's the hard work. It's gonna be hard, but you're going to find your edge like this, and you're never going to need another strategy again. Static RR, 1 to 1. Don't place an RR based off what you think is gonna happen. For my example, right? I use the fib as it's my trading. That's my concept, right? Simple. When I'm taking a trade, hold on, let me actually go to a setup that I kind of took. What was it? EU? Yeah, it was EU. Okay. Where was it? I think it was here. Okay, cool. Boom. Yeah. That was it right there. Actually, it was lower. It was this setup right here, matter of fact. Whatever. It was this setup right here. Right? So, simple. Boom, boom. Once it came in here, you enter. Right? Once it enter, boom. Place your stops below whatever. Wherever you choose to place your stops. Below the order block zone, below the fair value gap, below the market structure low, below support and resistance, below support, whatever, right? And then you just set it to 101, right? You need something that's going to have the same SL and take profit structure all the time. So it was easy for me on the fib because my levels was my SL and my take profit. My SL was the one right here. My take profit was this. It's that simple. So it was easy to structure out my trades. You're going to need to do something like that as well too. Right? So I'm going to head back to here really quickly. Cool. Right? Keep everything static. Right? Then the next thing you're going to do, you're going to trade that strategy over a sample size of anywhere from 50 to 100 trades. You can knock this out in 4 to 5 days. It's really simple. Depending on what's your trading style, if you're a swing trader, scalper, if you're a swing trader, bring it down to maybe 50. If you're an intraday or a scalp trader, if you're a scalp trader, bring it up to 150. If you're intraday, bring it to 100. The goal is to get a big sample size of these trades, a big sample size of data. And when you're taking these trades, right, take pictures of the trades. Take pictures of the trades. Every single trade, take a picture and put it in right next to the trade. So you're able to see these trades afterwards. And then after you take those trades, the goal is to get to a certain amount of trades. No matter what the outcome is here. Doesn't matter what the outcome is. Doesn't matter if I'm winning. Doesn't matter if I'm losing. You have to get to a certain amount of trades. So do 20. Scratch the 100. If this is your first time doing this, do 20. 20 trades. The goal is to take 20 trades. 20 trades with the exact one pair, one time frame, one model, static risk, static trade management. Exactly like that. Your trade setups should look quite similar every single trade. And the goal is to get to 20 trades. The goal isn't to be profitable. The goal isn't to have a high win rate. The goal isn't any of that. The goal is to get from one trade to 20 trades back tested with pictures. If you can't do that, you have a problem in your psychology. Most likely you have expectations that need to be handled. And this is a great way to find out if your struggles in trading is strategy based or is it more of psychology based. But anyway, the goal is to get 20 trades. Start off with 20. Now, once you get that 20 trades, it is time to review the data and see what variables or confluence worked. Let's say you're actually profitable. Let's say you become profitable, right? Let's say back test to 20 trades, you're profitable a certain percent, right? If you want to keep it exactly how it is, that's fine. But during those 20 trades, you have built something called subjective decision making, or you've unlocked it. What that basically means is you have experienced the markets through 20 trades of trading your edge. And you have noticed how the market has certain kind of react to certain scenarios or certain situations. For example, for me, every time the market hit this 79 level right here, I notice it always hit here. When trading that sample size, you'll be able to notice these things. Why? Why will you be able to notice these things? Simple. Because you have sat there and collected the data. You are not thinking about being profitable. You're not thinking about winning. You're just thinking about getting the 20 trades. So you're taking 20 of your setups, and this allows you to see how the market is actually moving to your setup. Now, after you got these 20 trades, you review the data, you see what worked, see what didn't, right? And the next thing is you start to experiment. So you'll take one variable. If you like your results, don't experiment. Leave it as that. That's your edge. That's all you need to focus on. Leave it exactly like that. Take 100 trades, see where your results is. But if you do want to test, you do want to tweak your strategy a little bit, you do want to improve your strategy a little bit, you can experiment. And this is the funnest part of the process for me. Because you take one variable and you change it. And then you take that same sample size again. So I took 20 before, and let's say I got a 37% win rate, and I made $9,000 on a $100,000 account. All right. Let's say, okay, cool. I tweak one variable. Maybe I cut my losers short here. And you experiment, and you see what the results are. Did I increase my win rate? Did I increase my profitability? And you keep doing this process over and over until you find your edge. The cool thing about this is when you're going through the ME process, mechanical edge engineering, you build subjective reasoning. You're able to build rational thinking and make rational decisions based off your experience because you're collecting a lot of experience watching how the market is moving. So now you're able to actually, right, when you're in certain situations where you didn't really understand how it worked, you're able to now make decisions based off the experience you've gathered through your strategy. So now losing 3 trades in a row doesn't bother you as much now because you know when I back tested over 100 trades, I'm based on average to lose 3 trades in a row for every whatever trades I win or whatever, right? You can look at the data and find out. And you say, well, I lose three trades in a row a lot. So this is normal. When you start losing more, 4, 5, 6, okay, now I know I'm doing something wrong. And you can figure these things out. And you're able to make more decisions based off your experience. All right? And you just keep repeating this process over and over. Now, the benefits of repeating this process. The benefits of this. Well, the first obvious is you find your strategy, you find your edge, right? and you build, the ability to transition over to the subjective side of trading. But you also pick up a couple of new perks. The first perk is you learn how to think in probabilities. This is by far one of the most important belief you need to have on trading. It allows you to separate your emotions. It allows you to separate most of your problems in trading, because you think on a trade by trade basis, to looking for results over a series of trades. So you're not getting caught up in the roller coaster of emotion of this trade I'm a winner, this trade I lost, this trade I lost, this trade I lost, this trade I'm winning. No, you're looking over, how did I do over 20 trades instead of how did I do on this trade? And you get to get rid of expectations, because you understand that I can't predict which trade is going to be a winner or a loser, but I can predict how I am going to be if I just follow my rules over a series of 20 trades. And I don't even like to use the word predict. I would say assume. You understand, or you know for certain that over 20 trades, as long as I keep following my rules and my process, I will be profitable. So the trades in the middle don't matter. And you learn how to think in probabilities. The second thing is you learn how to build experience. You can use this to become more of a subjective trader. That's kind of what I was saying, but you build more experience from how the market plays, and now you can make decisions that can help you lose a little bit more on your losers and make a little bit more on your winners. And then the third is you build self-confidence. And I got this from this book written by Dr. Brett Steinbarger. It's called The Daily Trading Coach. And I really like this quote a lot, because a lot of traders ask, how can I become a confident trader? And he says, confidence doesn't come from being right all the time. It comes from surviving the many occasions of being wrong. Another quote he had was, self-confidence. I'm sorry, I just kind of forgot the quote. I'm sorry. He said, self-confidence, I'm just going to summarize it basically. It says self-confidence doesn't come from, being confident in certain affirmations. What self-confidence is just basically you understand that no matter what happens, you can handle it. If you lose 20 trades, 30 trades, whatever, that confidence as a trader, right, is just knowing that I can handle whatever the market throws at me. That's where confidence as a trader comes in. Confidence comes from surviving the many times of being wrong, because you are constantly going at battle with the thing you fear most, losing money and being wrong. And when you constantly go at battle with it, and then over time you start to realize, hey, this isn't so bad actually. Hey, this isn't as bad as I thought it was. That's when you'll start to build confidence, because you understand the worst thing that you was afraid of will allow you, even if it does happen, you can handle it. Building your edge through mechanical trading is the only way you're going to find what you're looking for. I hope some of you guys gained value from this. My socials are on the screen if you want to give me a follow. And this all came from my psychology study that I'm doing 100 minutes a day of studying psychology. And this came from Mark Douglas. Just type in Mark Douglas and mechanical trading or mechanical trading, and he'll give you a little bit more of a clear guide. But until next time, y'all.